want to look at how much gold do I need to recoup any of those fees, any of those taxes, any of those losses. Because when the government sets up these systems, they seriously think about how high those fees need to be to prevent you from wanting to take it out. So a lot of people, if you've got $100,000 in your IRA and they go, well, I don't want to pay the taxes on that. You need to understand, number one, you're never getting away from paying the taxes on it. So you need to determine when you want to pay those taxes, not allow the government or the IRS or the central banks to determine that, because it won't be in your best interest. And number two, how do I recoup it? So the plan actually is based upon how much gold do I need to recoup it, because gold is the primary currency metal and it outperforms everything else during a hyperinflationary event. And then finally, you want to expand your ability to live, your current standard of living, and you also want to gather enough income producing assets, which right now they're at nosebleed level. You can't do it. They're too expensive. But moving into the future where gold is undervalued, those assets are overvalued, that's going to flip-flop, right? So you're going to take advantage of that flip-flop and you're going to buy into, without debt, those income producing assets when they're cheap. Right now, they're not cheap. So proper diversification, no matter what you're holding, includes sound money, and it must be physical and it must be in your possession. So even if you have a gold or silver IRA, which if that's what your level of comfort is, that's what you need to do, regardless of what anybody says. But let's properly diversify outside of that, or any bullion holdings that you choose to have, because you can only do bullion in an IRA. You want to properly diversify even in the precious metals arena. Does that make sense? So part of it, if you're holding it in a traditional IRA, at this point, it's going to flow with the spot gold market, right? Which is a contract. So how do you know this is a positive trend? What you see are higher and higher and higher lows. Here's a guarantee I can give you. If you keep getting higher and higher lows, you're going to get higher highs. Not rocket science. It's just logic, and it always happens. We see cup formations here as well. Here's one, and we've recently had a breakout. So the long-term positive trend is escalating. It was slower here. It picked up steam here. It's picking up steam here, right? So the trend is getting faster and faster. We're going into a breakout. At the same time, that volume is escalating, because even this volume over here is higher than the volume over there. But that's trading volume, right? We also know in the buying of the physical volume, that too is escalating. But this is what at this time guides those bullion prices, the kind that you can hold inside of an IRA, or even the kind of emergency gold, which I like the raw stuff for. Outside of the IRA, it's going to be guided by this market at this moment. That won't always be true. It hasn't always been true.
Gold is the ultimate form of wealth insurance. It has withstood the test of time, acting as a store of value for thousands of years, long before paper currencies even existed. With the instability of financial markets, the increasing debt burdens of governments, and the hidden taxation of inflation, gold is not just an investment, it is a financial necessity. The reality is that the purchasing power of fiat currency is in a perpetual state of decline, and we must ask ourselves, how do we protect our wealth against an inevitable financial system reset? The primary strategy revolves around understanding how much gold is needed to offset potential losses caused by government-imposed fees, taxes, and the devaluation of fiat currency. Many investors hold their wealth in retirement accounts, believing that deferring taxes on their savings is the best course of action. However, what most don't realize is that they are merely postponing taxation, not avoiding it. By the time they withdraw from these accounts, they could face significantly higher taxes and fees due to government policies aimed at keeping people trapped in the system. The critical decision then becomes, when is the right time to exit? And how do you ensure that your assets retain their value after taxation? Gold plays a central role in this equation because it outperforms other assets during hyperinflationary events. Historically, whenever a fiat system collapses, gold remains the standard for value exchange. Many people today are sitting on overvalued assets, such as real estate, stocks, and bonds, failing to realize that these assets are priced at unsustainable levels. The plan, then, should be to accumulate physical gold, wait for the inevitable revaluation, and then convert that gold into undervalued assets, such as income-producing real estate, when the time is right. The key to proper diversification is ensuring that at least a portion of your wealth is held in physical, tangible assets that are not controlled by the banking system. Gold must be in your possession, not held in an ETF, a vault controlled by a third party, or a digital ledger. While gold and silver IRAs may seem attractive, they still require you to keep your metals within the banking system, which means they can be frozen, taxed, or even confiscated under emergency financial measures. That is why it is crucial to hold a significant portion of your gold outside the system in forms that are easily accessible and not dependent on financial institutions. Many people ask, how do we know that gold is in a long-term bullish trend? The answer lies in price patterns. Gold has been making higher lows for years, which is a classic indicator of a strengthening bull market. The logic here is simple. If an asset consistently sets higher lows, it will eventually make higher highs. We are seeing cup and handle formations on gold charts, suggesting that gold is on the verge of a breakout to new all-time highs. When demand for physical metals escalates while available supply remains constrained, premiums on physical gold widen dramatically, reinforcing the importance of owning real metal rather than paper contracts. Another critical factor to consider is the ability of financial institutions to manipulate gold prices through paper contracts. The futures markets allow banks and institutions to create vast amounts of gold contracts that aren't backed by physical metal, artificially suppressing prices. However, this manipulation has limits, and when physical demand outstrips the ability of paper markets to control the price, we will see an explosive move higher. Looking back at historical trends, we see a repeating pattern. The gold bullion index started at a baseline of 1,000 in 1970. After the U.S. removed the gold standard in 1971, we saw a massive run-up in gold prices. The standardization of coin grading in 1986 further drove demand, and we witnessed enormous price increases. Gold then went through a period of consolidation before another surge in 2008. Today, we are on the verge of another massive move, and yet gold remains significantly undervalued relative to historical highs. As central banks continue their massive gold acquisitions, it's evident that those in power understand what is coming. If we follow the cycle, history tells us that when gold undergoes a major reset, it is the only asset that will allow investors to regain lost purchasing power. The question is not whether this will happen, but when.
But the premiums just get a lot wider, and we'll see that happening into the future because this is paper. They can create as much gold and silver that doesn't exist as they want to. So this is where this market started back in 1970, and the index an index is a whole bunch of coins, a whole bunch of these, right? Put together, and that index started at 1,000. You can see that once gold was legalized to hold again, that we had a huge spike. We did that in spot market too, but more so in this market because this is a finite market, especially since in 1986, they standardized the grading of these coins. Up until that point, if I were a dealer, I could look at this kind of go, oh, I think this is a mint state 65. And sell it to you that way, and maybe it was really a mint state 61. So the whole industry was standardized, and it really took off. And then, of course, you have this huge drop down. So what I'm showing you over here in 94, that's when you had the bottom of that index at almost 47,000. This is the bottom dip right now. 2021 was the bottom that this index dipped to. It's higher than this one though, as we can see, right? Higher and higher lows indicates a higher trend. And we have had a little breakout, but we still have not hit the peak that we did in 2008, right? So those premiums are going to grow if history is any guide, which it typically is, but these are severely undervalued. And my personal expectation is that number one, we have to go and hit this top line, and we're on our way there. We're close to a second breakout. And then, well, we don't have anything until this one here. So these coins are most likely technically to go a lot higher because, as you can see, for this entire year, they've just gone up and up and up. We need that second breakout. We will get it. When we get it, I will let you know. But essentially, we're still severely undervalued from where the high was back in 89, right? Which was 181,000 to that index. Will it go there? My guess is yes, but I can't guarantee that. However, we are starting from a severely undervalued level, and there's no fever like gold fever. And especially if they do indeed do a covert or an overt confiscation, and now this is the only way that you can hold gold, what do you think are going to happen in terms of prices? And when we do that reset, what do you think is going to happen in terms of price? It's going through the roof. And that's why you can then take those gains and convert it into those underlying income-producing assets when they are cheap.
The trajectory of gold and silver prices remains one of the most fascinating financial stories of our time, and the reasons for their movement are deeply rooted in economic fundamentals, geopolitical shifts, and the relentless devaluation of fiat currencies. We often hear about gold as a hedge against inflation, but in reality, gold is more than just a passive store of value. It is an active barometer of economic distress, signaling cracks in the foundation of our financial system. When central banks continue to expand their balance sheets with reckless abandon, accumulating debt at an unprecedented pace, gold and silver serve as the last bastions of monetary stability. Over the past few years, we have witnessed an extraordinary level of gold accumulation by central banks, particularly among BRICS nations and emerging economies. This shift is not happening in isolation, but rather in response to a much larger global trend: the erosion of trust in the US dollar as the world's primary reserve currency. Nations like China, Russia, and India are aggressively increasing their gold reserves, not as a speculative asset, but as a strategic financial weapon to hedge against a future where the dollar's hegemony is significantly weakened. The International Monetary Fund, IMF, and the Bank for International Settlements, BIS, are well aware of this shift. Yet Western media largely ignores the topic, preferring instead to distract the public with headlines about stock market gains, digital assets, and speculative bubbles that do little to preserve long-term wealth. It is crucial to understand that gold is not simply an investment. Gold is money, the original and most enduring form of money known to humanity. While central banks around the world continue to print fiat currency at an alarming rate, devaluing their money to cover government deficits and maintain short-term political stability, gold remains a finite and incorruptible asset. The very same institutions that publicly dismiss gold as an outdated relic are, behind the scenes, among its biggest buyers. This should tell you everything you need to know about where we are headed. Over the last few years, the BRICS nations have strategically positioned themselves to reduce their reliance on the dollar by establishing alternative payment mechanisms, including the BRICS Bridge and BRICS Pay settlement systems, which will allow international trade to be conducted in local currencies rather than through the dollar. However, as I've mentioned before, the most significant development is the potential backing of these settlement systems with gold. This is a game changer. If a country like Russia or China begins offering settlement in a gold-backed digital currency, the repercussions for the dollar could be seismic. The demand for gold in such a system would be astronomical, further straining global supply and driving prices to levels we have never seen before. We must also look at the internal dynamics of the US economy and how they impact gold and silver prices. Inflation remains persistent despite the Federal Reserve's attempts to convince the public otherwise. Even their own adjusted consumer price index, CPI, figures fail to accurately capture the true loss of purchasing power in the economy. Ask yourself this: does the official 2.6% inflation rate reflect your real-world experience? If you've gone grocery shopping, paid your rent or mortgage, or attempted to buy a car recently, You know that inflation is far higher than what the government reports. Many of us are experiencing an erosion of purchasing power closer to 7 to 8% annually. The bond market has begun to recognize this reality, and yields have started rising again. The 30-year Treasury yield is now approaching 5%, while the 10-year sits well above 4.5%, signaling that the market is losing confidence in the Fed's ability to contain inflation. Higher bond yields mean increased borrowing costs for the U.S. government, which is already drowning in over $36 trillion in debt. With deficit spending still out of control, the government has no choice but to issue more treasuries, further inflating the debt bubble. And when foreign buyers, particularly BRICS nations, begin reducing their purchases of U.S. debt in favor of gold, the impact on the dollar's stability will be profound. Gold and silver historically have always responded to fiscal irresponsibility. The 1970s taught us this lesson when gold soared from $35 an ounce to over $800 by the end of the decade, as inflation spiraled out of control. If history is any indication, we are now entering a similar, if not more extreme phase. Unlike the 1970s, however, we are dealing with a far more interconnected global financial system, an exponentially larger debt load, and the very real possibility of a multipolar monetary order emerging. In such a scenario, gold could move from its current levels of $2,700 an ounce to $10,000 or even $15,000 an ounce in the coming years. Silver, historically a more volatile but highly undervalued monetary metal, could see even greater percentage gains. As industrial demand for silver continues to surge, driven by solar energy, electric vehicles, and technology applications, supply constraints will become even more evident. Unlike gold, which is primarily held in vaults, silver is consumed in industrial processes and is not easily recoverable. This creates a scenario where both investment and industrial demand collide, pushing prices dramatically higher. Meanwhile, the stock market and real estate bubbles continue to defy gravity. But for how long? Insiders at major corporations are selling stock at an alarming pace, signaling that those who truly understand the financial system are preparing for the next downturn. The stock market remains artificially inflated by cheap credit, corporate buybacks, and a speculative retail investment frenzy. When interest rates remain elevated for longer than expected, as the Fed has now admitted, these bubbles will start to deflate. Real estate markets, particularly commercial real estate, are already facing severe stress. The collapse of regional banks exposed to commercial property loans is just a preview of what's to come. If the Fed is forced to intervene yet again with another round of money printing, it will only serve to accelerate the devaluation of the dollar, further strengthening the case for gold and silver. Investors who are paying attention to these macroeconomic trends are moving into tangible assets, physical metals, productive farmland, and energy-related commodities, while the general public remains distracted by speculative hype. What is particularly alarming is that most people are not prepared for what's coming. They are lulled into a false sense of security by rising stock prices and political promises that everything will be fine. But the reality is that systemic risk is growing by the day. The U.S. government is on an unsustainable fiscal trajectory, and no amount of political maneuvering will change that. The question is not whether we will see a monetary reset, but how and when it will happen. The central banks already know this, which is why they continue to buy gold at record levels. When the dust settles, those who have positioned themselves wisely by owning physical metals, holding real assets, and reducing exposure to counterparty risk, will not only preserve their wealth, but will be in a position to thrive. As we move forward, it is imperative to remain informed, think critically, and not fall into the trap of complacency. The writing is on the wall, and those who recognize it will be well ahead of the curve. The time to act is now. Gold and silver are not just financial instruments. They are historical safeguards against reckless monetary policies and government mismanagement. And as we enter a new era of economic uncertainty, they will prove to be the ultimate store of value. Those who understand this will not only protect their wealth, but ensure financial sovereignty in a world that is rapidly changing.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.